Welcome back. Before we take a look at the day's business news, let's take a look at the stock indices across the GCC. And in our top business story, Abu Dhabi's inflation rate rose to its highest level since July 2011 in December. That's according to new data released by the Emirates Statistics Centre. Its December consumer price data showed housing and utility costs, which account for almost 38% of consumer expenses, gained 1.5% from a year earlier. Last November, Abu Dhabi scrapped a 5% cap on annual rent increases, opening up a property sector where many tenants were paying below market rents. Prices of food and non-alcoholic beverages, which account for 16% of the basket, rose 4.6% in December. In November, they increased 3.8% on an annual basis. Inflation for the whole of 2013 was 1.3%, the centre said. Experts have forecast that on average, inflation in the UAE would accelerate to 1.5% in 2013 and 2.3% in 2014, from 0.7% in 2012, which saw the lowest level since 1990. Middle Eastern carriers reported the largest increase in air cargo growth in November 2013, when compared to the same month in the previous year, according to the International Air Transport Association IATA. The figures revealed that Middle Eastern airlines exceeded the global average of 6.1%, reporting a 16.5% jump in air freight, measured in freight ton kilometers. Commenting on the figures, IATA stated that improvements in advanced economies, including Europe, are proving beneficial to the Middle Eastern carriers, who are also benefiting from solid economic and trade growth in the Gulf, adding that the trend is likely to continue with indicators showing record high export orders in the UAE, which bodes well for continued growth in the region's trade volumes. While the Middle East led the way with double-digit growth in air freight for November, the global average of 6.1% is an improvement on the 4.4% October 2013 increase. Overall, all regions except Latin America and Africa reported growth in November. Shuaa Capital has released its preliminary results for the fourth quarter and full year 2013 today, with the company recording revenues of around 63 million dirhams for the fourth quarter, an increase of 153% compared to revenues of 25 million dirhams in the fourth quarter of 2012. Net profit was reported at around 3.8 million dirhams in the fourth quarter 2013 versus a net loss of 21 million dirhams in the fourth quarter of 2012. For the year, net profit was approximately 2.8 million dirhams, up 62 million dirhams from a net loss of 59 million dirhams in 2012. Revenues generated in 2013 were approximately 198 million dirhams, a 44% increase versus 137 million dirhams in 2012. All revenue-generating business divisions were profitable in 2013 and contributed to this strong performance. Commenting on the preliminary figures in a statement from the company, His Highness Sheikh Maktoum Hashir Al Maktoum, Executive Chairman of Shuaa Capital, said that rigorous cost control has produced this significant result and marks the turning point for the company, adding that the 2013 results clearly demonstrate the success of the company's strategic transformation. Shuaa expects to publish its earnings and release and audited financial statements for the fourth quarter and full year 2013 on 14 February 2014. Markets closed the week on the back foot as a much weaker than expected US non-farm payroll report kept risk appetite in check. With expectations of 197,000 new jobs expected in December, the actual figure came at a paltry 74,000 new jobs, which reminded markets of the fragile state of the US recovery. The US dollar came under sustained pressure following the news, as expectations that Fed taper would continue boosted the majors against the greenback. To talk more about this and the week ahead, we earlier spoke with Gaurav Kashyap, the head of futures at Al Pari Middle East.
Last week's U.S. non-farm payroll report announced on Friday sprung a major surprise and greatly disappointing markets when it came in at only 74,000 new jobs added December. Remember, this is well below expectations of 197,000 jobs, and it was the largest miss in the payroll report since December 2009. Overall, the unemployment rate did show signs of improvement, coming in at 6.7%. That's below expectations of 7%. But once again, the gains in the unemployment rate were all for the wrong reasons. The overall labor force participation rate dropped to 62.7%, the lowest level since 1978. So with more and more people leaving the labor force, this is continuing to skew the overall unemployment rate. So overall, the jobs report was extremely bad. We saw U.S. Treasury yields dip on the news. The U.S. dollar index also sold off rather aggressively, and U.S. stocks were also moving slightly lower following that announcement. Now, overall, the negative U.S. non-farm payroll report will not do much to change the Fed's plan to introduce that $10 billion taper in January. So we expect that to continue as it is. But overall, what this report does show us is that we may not be out of the woods as yet. A lot of the optimism that we experienced towards the end of Q4 might be a bit misled, and overall we'll need to wait and watch how the next NFP report comes to actually gauge how the jobs recovery is going in the US. Overall, we are looking at a host of inflation data coming out this week. The UK will be announcing their consumer prices along with the Eurozone as well as the US. But overall, markets will remain mixed to higher against the US dollar. We expect the euro to test about 138 in the week ahead. The British pound looks good to test 166, and gold looks good to consolidate between 1220 and 1280 in the week ahead.